Hey guys, what's up? I wanted to come on here and make a quick video about a question that someone had asked me in terms of getting a loan from a bank for a property and how the bank looks at you in terms of your income, your credit, and things like that. Well, what I was explaining to him, or tried to explain to him in the comments underneath my last video, was that anything 4, 3, 2, or 1 unit. So a single family home, a duplex, a threeplex, a fourplex, those are all going to be looked at as you basically buying a single family home or just trying to get a personal residential loan for maybe you to live in a unit and maybe rent out to some other people. But anything 4 units and under is just, they're going to be looking at your job, or your income, however you get it. Can you afford to pay for this purchase? How your credit looks personally. They're going to be looking at you personally for all of the information in order to see if you can afford to buy this property. Well, once you get to 5 units and more, then you're considered commercial property. So if you're buying something that's 5 units, 10 units, 15 units, 100 units, they're going to be looking more so at the property. Can the property sustain the loan payment? So if you're renting to 5 people, 5 2-bedroom, 2 baths, and they're each going to go for $800 each, is that enough money for you to pay all the expenses on that property, for you to pay the taxes, the mortgage, everything on the property, and hopefully come out with some cash flow? And so they're going to be looking more so at the property first, and then everything else is secondary, like, your credit, your income. Then they're going to look at those things second. So the major difference is if it's considered just a residential property, 4 units and under, they're looking at all your personal information, your income, credit, all of that. Where once you get into commercial, 5 units and over, they look at the property itself first. They want to see the rent rolls. They want to see all of these different things to see. That's why you'll see a vacant apartment building that's empty. That building cannot be financed. It's probably not going to be financeable because if it's vacant, if it's empty, there are no rent rolls. There is no past history on the building. Let's say it's been empty for 2 years. You can't show anything of the building generating any money, anything like that. So then that means you would have to find an all cash buyer. So you'll probably call someone and they'll be like, hey, you have to come in cash with this deal because you do know that this deal probably can't be financed. So and once you get into it more, you'll kind of learn these things. I mean, I know because I've bought buildings that have been empty. Nobody's living in them. They need to be totally remodeled and things like that. But once you get into it, then you kind of see more and you kind of understand more what the bank is looking for and what they want. And also you learn very quickly. I mean, just from doing your research, you should have already learned that the difference between what's considered a residential property and what's considered a commercial property. All right, so if you have any questions, just let me know down below. Remember, rate, comment, subscribe, all that good stuff. And hey, all of a sudden I got like a jump in subscribers, like a huge boost. So I want to say hello and thank you for subscribing to all my new subscribers. I appreciate it. And yeah, so I'll talk to you guys later. All right, bye. Ask me anything you want to ask me below.